You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Stocks extended multi-year highs early in the week, then returned to being range-bound through the latter part of the week. Investor sentiment remained mostly upbeat as investors continued to focus on positive corporate earnings, but they also kept at least one eye on continued uncertainty over Egypt's future. Another interest rate hike by China, their latest attempt to hold down inflation in that region, got little, if any, market reaction during the week. Meanwhile, speaking before the House Budget Committee, Fed Chief Bernanke reiterated his benign view of inflation here and said it will be likely several years before the U.S. unemployment rate returns to more normal levels. However, there was some good jobs news this week, and that was on Thursday, when it was reported that weekly jobless claims fell last week to more than a two-year low. We'll be talking about inflation a little bit more at the roundtable, but right now Steve Reitmeister is back with me once again to talk more about this seemingly tale of the still bullish tape. This market seems to be taking on a life of its own here. You wrote this week that the length and strength of the rally continues to amaze you. But you're still willing to ride the rally, huh? Ride the bull out.
Yeah, I mean, in the longer-term future, you know, it's clear that the economic rebound is still in play, and I think it's even building up a little bit of steam here, and we could see GDP of 3.5 to 4 ringing up later this year, which is very good, and corporate earnings are strong, and the valuations of stocks are reasonable, so no reason not to play ball, you know, with the market. But, you know, it's got to take a pause somewhere, and I have a sense that might be at this moment.
Why do you think it is that investors seem not to be deterred by some of the other global headwinds, like the upheaval in the Middle East region and interest rates here that seem to be creeping higher?
Yeah. You know, first, because the fundamental story is still so strong. So everything I just said in that if the answer to the first question kind of sets the paces, and that's still very attractive. And then secondly, you have the boy who cried wolf syndrome, okay? Mm-hmm. We hear about all these problems and, oh, we should be worried, and China inflation and European banks, or I say European debt issues and things of that nature, yet they keep seeming not to have any effect on the U.S. economic engine. Mm-hmm. So I think that we're becoming a little more numb to them. Now, it's foolish to become 100% numb to them, but it's almost like when they're a real problem, someone wake up and tell me, and then I'll react. But until then, it just sounds like another mirage that keeps not appearing.
All right, let's switch it back over to corporate earnings. You know, if the earnings trends continue that are in place, data shows that as positive as it's been, if they continue, fourth quarter 2010 could shape up to be the 7th consecutive quarter of earnings outperformance, and outperformance by a wide margin. So doesn't this just show the power of earnings momentum for all of corporate America as a whole? Yeah.
You know, that's one of my favorite topics is the concept of earnings momentum. Because when people think momentum, they think too much of technical momentum, like the share price movement, things of that nature. But there's a certain, you know, organic beauty to the idea of momentum. When things are going in the right direction, they seem to continue to go in the right direction. And there's a self-fulfilling, self-sustaining quality that can happen to whether it be economic momentum, mm-hmm. Which then for corporations becomes earnings momentum. And we certainly see that in play here. And that's why quarter after quarter they keep not just meeting expectations, they're beating expectations, and guidance goes higher for the next quarter, which is excellent for the stock market.
So then give us some weekend wisdom, since it is a favorite topic of yours, on how to find these companies with the best earnings momentum.
Right. I think too often people think about things that are not very tangible. Oh, let's look for a great management team, but how are you going to judge that? Or let's take a look, they have great products. Well, there's a lot of folks with great profits. I mean, you have to dig into the numbers, and the best number that shows earnings momentum is earnings estimate revisions. And I know I keep beating that horse, but you know, it's the best horse in town, so I got to keep riding that horse, right? Mm-hmm. So companies that continue to beat earnings expectations, to see higher estimates after that, those are the ones with the strongest earnings momentum. And then year after year, these are the companies that generally provide the best rates of return. So whether you use a free screener on Yahoo or Zacks.com to find stocks with the highest earnings estimate revisions, you can certainly do that. And those would be a great place to find stocks. Or Here again, our Zacks #1 ratings are another great place to go and find specific stocks that are having this strong earnings momentum.
Is it hard to find those in this kind of a market, or do earnings act independently of?
The hard part is that there are so many experiencing strong earnings momentum that it is to narrow it down. And what you do is you find the ones with the most extreme earnings momentum. So in other words, a lot of folks are beating earnings. Who's beating it by the widest margins? Who's seeing the strongest estimate revisions afterwards? So if earnings were expected to be $1 and are now up to $1.05, yeah, that's nice, that's 5%. But how about the guy who's expected to earn $1 and is now expected to earn $1.20, $1.30? Those companies are out there, and using things like the free screeners on many websites, you could absolutely find them.
Okay, we will see you back at the round table. Meantime, more still ahead, so stick with us here on Profit from the Pros. Here is your Bull and Bear Stock of the Week. A retailer of sorts and an electrical component manufacturer make up this week's Bull and Bear of the Week. And joining us this time to fill us in on these two stocks is equity strategist Bill Wilton, sitting in for Shiraz Mian. So, Tractor Supply Company is that retailer loosely categorized, but I guess they can be because they sell tractors, right?
Well, they sell, a lot more than that. I mean, it's kind of analogous to a farm and fleet, if you're familiar with them.
Oh, yeah.
Anything from, clothing, apparel, lawnmowers, lawn and garden supplies. So
okay, so they really are a retailer then.
Yeah, but they do focus on more of the rural market, and that's one of the reasons that they are a bullish story right now. The ag play is going off the charts right now, so a lot of that added wealth from higher ag prices is trickling down to those rural areas. So a retailer that focuses on that region, it makes sense that they're going to get the most benefit from that. Recently, they reported some great quarterly results. They beat Wall Street's expectations. They saw double-digit growth on both same-store sales and an aggregate level, which is obviously what you want to see, because the top-line growth is what's going to keep going. You can only widen your margins so much. So as long as that top line keeps improving, things are going to be going well. They also haven't missed an earnings estimate since mid-2008, so they're on a good run right now.
Yeah.
Currently, Wall Street is expecting 17% growth this year, another 14% next year. So we're not seeing any slowdown in this in the current growth trajectory, which is fantastic. And shares are trading at an all-time high right now. But given the momentum that they're seeing, the bullish sentiment on the street, there's no reason to think that that's going to stop anytime soon.
All right, and that electrical component company that we mentioned is Plexus Corp, PLXS, ticker symbol on the NASDAQ. Why is this a bear?
Well, one of the biggest reasons is that they gave a weaker outlook into the future because a couple of their major customers are actually slowing down their production. And that's one of the other key concerns about a company like this. They only have a few major customers, so if you see a slowdown in any one or two of those, which we are seeing, that can make a huge dent in their top line, which obviously is going to impact the bottom line exponentially. So estimates are falling. A lot of analysts are starting to become more and more bearish on them. Their cash flows are weakening, which is definitely a bad sign there. And they actually projected a raw material and component shortage that has been going on. They're now expecting that to continue throughout 2011. So all in all, there's just not a lot to be happy about here.
So they manufacture by contract. That can be difficult in any industry, really.
Definitely, because once that contract expires, there's no guarantee that it's going to be renewed. So you have a lot of this, almost like a choppy revenue stream, or at least it could be. So if you do have one of the customers who wants to reduce their the amount of business they do with you, or end it altogether, in an industry like this, that's going to put a huge chunk in your profitability in the long run.
They also do a lot of defense work.
Yeah,
which can be kind of a lumpy
definitely,
area.
Especially when it comes to government spending, things like that.
Right.
These are high-ticket items. So when you have, like I've said, a few customers with very high-ticket items, it only takes one or two orders or one or two, production schedules to get interrupted or slowed down for them to feel some pain on that one.
Right. Okay. Well, thanks. We appreciate your help on this. And we have more coming up straight ahead. It's Stock Talk, and it's interesting. Stick with us. And now, Stock Talk, analysis of stocks in the news. According to published reports, AOL used up about 40% of its cash purchasing the Huffington Post this week. The acquisition reportedly totaled $315 million. Our equity strategists Tracy Reinick and Mike Vodek are here now to take a closer look at AOL. And the breakdown, Tracy, that I read goes like this. About $30 million in cash to cover expenses, $300 million in cash as well. And that is about 40% of the $802 million in cash that they had on hand.
Yep.
So is this a good thing?
Well, I mean, AOL is trying to survive. They're going away from their former, platform,
model,
yeah,
right.
of the whole search and all of that, and they're trying to become a content provider. And
right.
obviously, Huffington Post fits in with that. I mean, Huffington Post had 36 million unique visitors a month. That's a big, piece of the pie that they can get, and with this acquisition they're going to have up to about 300 million users a month. Now the whole goal is to create more advertising revenue and things like that,
right.
but I mean revenue was really down last year, so they're going to need it. It was down 26%. So this is kind of, some people are saying it was like the Hail Mary pass.
Right.
It kind of is for them because they have to have this work in order to survive.
Mike, this was announced on Monday of this past week, and at the end of the day on Monday, the stock of AOL was down about 1% on the day after having been down about 4% earlier in the session after the news was announced.
Yeah.
So what's the momentum on this stock looking like right now, good or bad?
I would say negative. This chart is really a great example of how old habits die hard.
Okay.
Because the chart still looks really weak, and that tells us that the market doesn't particularly like what's going on. They may have some doubts about what's happening. But the chart I have right now here is 6-month chart, and what you see is shares have been relatively weak over the last week or so. We see some pretty serious downward pressure. And then on a longer term basis, the second chart I have here is this $20 level. It's a very key long-term level. So it looks like shares are kind of checking that area out a little bit. And if they get below 20, there could be more downside, but that's definitely going to be a key area, $20 for everyone to keep their eye on.
Yeah, the daily range doesn't go out of that $20 range by much, just by pennies. And I found it kind of curious that there's no, at least I couldn't find a 52-week range available on the stock. I don't know if you were able to.
Yeah, you know what? The 52-week range, the high is right about $30, and we're at about $20 now. So that's about 50% of the actual the recent movement has been 50% of the 52-week range. So it's been moving around. It's been pretty volatile.
All right. So if the high end of the range is around 30, the one-year target estimate is only like $26 or $26.31. So that itself doesn't really make a good statement, does it?
Yeah, it sounds like the analysts might be a little bit bullish on this, but what we're seeing from the market just in the last couple of days here is that there has been some downward pressure, so the market's not really liking what they're seeing right now.
So they're going, Tracy, to try to change their model to become a content provider. Right. And they thought Huffington was a good choice because Huffington has a lot of eyes on their websites.
That's right.
I guess time will tell on this one.
Yeah, I mean, Huffington is one of the top 10 visited sites every day. So they're hoping to get some synergies with that, and then they're going to have Arianna Huffington, who ran the Huffington Post,
right.
oversee all of their content. I mean, they've been acquiring a lot of blogs and other things. They acquired TechCrunch in the last couple months as well, and that has like 3 or 4 million viewers as well. So they're trying to acquire all these content providers with the hope of, creating some kind of synergies here.
Yeah, I thought it was kind of curious that they took her along with the package, made her part of the package. Thanks for the info. We'll keep our eye on this one. Roundtable is next. Stick with us. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Inflation, Fed Chairman Bernanke, and the stock market. That's all on the docket for this week's Roundtable. And as always, top stock picks from Editor-at-Large Steve Reitmeister, market technician Kevin Matris, and equity strategist Tracy Reinick. And you confused me a little bit because you switched seats on me this week. So, once you get old, you can't do that to people. Yes. It confuses us. Tracy, I'm going to start with you this week.
Okay.
Because we were talking about this a little bit before we started rolling tape here. Fed chairman this week took his usual benign view of inflation here in the country. However, we can't ignore what's going on around the world. We have rising grain prices all over the place. Right. Corn limit up earlier this week on a bad crop report. Do these rising grain prices suggest in any way that inflation is here?
Well, sure, because we're going to have food prices rising here. I mean, we've already seen that with a whole bunch of companies. Like Sara Lee just said they were raising prices across the board on every single product. We had Smucker's raising prices 10% on all their coffee. We had a couple other food companies all saying we're trying to push through the costs. So yeah, we're definitely seeing it here. And you can't escape what is going on around the world with these other countries all starting to raise interest rates. They're all seeing rates up as high as 5-6%. Brazil's at 6% inflation rate now.
Right.
So, and they're a huge bread basket as we are with food and everything. So, Bernanke can say, I'm looking at the core, that's all I'm looking at, but the American consumer is going to look at far more than the core.
Right. So, Steve, does he just not see it? Or is he just choosing to ignore it? I mean, he said this week that it's not homegrown inflation. That's like me saying, if I don't have pizza for lunch, I'm 150 pounds.
Right.
Right?
But here again, what he's talking about is he believes the things that are more sustainable. So in other words, everyone says that food prices and energy prices fluctuate far too much and that this could blow past and be just fine. So what he's concerned about with structural inflation are things such as wages, okay? And he's not seeing much pressure on the wage front because there's still such high unemployment.
Okay.
And also there's too much excess capacity in terms of production within the country. Right. And so these are things that he thinks that will keep inflation, right, but benign was the right word. But it's funny because the bond market, which has a decent track record of guessing future inflation, they're not right now seeming to be too worried. So with the 10-year at 3.7 and 30-year at 4.7, they're saying we're not seeing that much inflation on the horizon. So maybe there's some other smart folks who are agreeing with Bernanke for now.
So Kevin, but investors seem to be still keeping at least one eye on this inflation scenario to see how it plays out. Could it be that slight investor concern, slight as it may be,
right,
that's keeping this market range bound here?
Well, getting back to the inflation target, it is true, you're looking at food inflation around the world, but inflation for food in the U.S. is very, very low. And we also have to remember that the Fed's policies were geared to be able to combat deflation. So even though we're looking at some inflation right now, the Fed's stated inflation target is 1.7%. And it is true, it seems as if he's not really paying attention to the other stuff. He's only looking at the core. Mm-hmm. But if you were to look at the core inflation right now, core inflation is only 0.7%. It is actually significantly lower than where we were last year. And I think he's going to continue to focus on this because a lot of the stuff that we're seeing with the food inflation, a lot of it is weather related as well. So I think investors are a little bit wary about it, but as long as the Fed believes that it is low, and as long as the Fed believes that they can contain it and it is stable, I think investors are going to continue to go along with the Fed, and I think the market still has the ability of being able to push higher.
Okay, so then he did note, though, that the employment situation is going to be a drag
right
on the economy, even though the growth does seem to be, going along slow and steady. There are people who are predicting that a lot of jobs are going to be added this year, Steve. Seems to be mixed reports, mixed signals coming.
We kind of poo-pooed the government's January employment situation report last week. I think that it's not properly looking at the positives in the employment picture, as well as we can see clearly from the jobless claims and from the ADP report and some of the other things like ISM also has their own measures of unemployment, and they are getting better. I'm not, for one, believing that's going to be a boom time for unemployment, but it is getting better, and what's important is the direction. If the direction is better, that is better for the economy, more people with incomes, more people spending, and so on and so forth. So I think that the direction has clearly changed for the better, after kind of just stalling out for a while. Mm-hmm. And I think that 2011 will be the year that employment gets better, but it won't be 5% again for 3 to 5 years.
Kevin?
Yeah, real quick, when Bernanke was talking in front of Congress, earlier this week, he had specifically mentioned that the consumer sector is doing fantastic. He talked about robust increases in business investment and all of that stuff. But I had said earlier this year that we were going to see unemployment drop to 8% or below. Everybody scoffed at me. I still think that that's where we're going.
Okay, Tracy, give me your top stock pick for this week quickly.
It is Interdigital, which is IDCC, and they are in wireless technologies. And so this is a hot area. They specifically make a lot of technologies for the smartphones, which is why revenues are soaring. It was up 22% in the last quarter. They actually report in 2 weeks, so we'll see what they just did for the fourth quarter. But you know, this area is hot. Like everybody wants a smartphone, and
right.
you know, they're trading at 17 times, so they're not real expensive here.
Okay, Kevin.
I have the best company name in the history of company names, Horsehead Holdings. The ticker is ZINC, zinc. They are in the metal processing and fabrication industry. They produce a bunch of zinc-based products. They also do a bunch of cleanup for the steel industry. Here's the cliff notes. Industry is the top 10% of industries. They're one of the top stocks within the industry. Triple-digit growth rate, very attractive valuations, big surprises on both sales and earnings, and I'm looking for a 25% increase from where we are right now.
Okay, Steve.
And the best stock name ever. So
Yeah,
can't
right.
forget
It's
the one.
comments like that that make us all wonder where your mind travels, Kevin.
But for me, quickly, Eaton, which is a large industrial player. Industrial is clearly one of the stronger segments right now. And what I like about them, they have a diversified set of businesses, and a lot of them are what they call light cycle businesses. So as the economy expands later into the cycle, these businesses pick up. So I think there's a lot of earnings momentum that we talked about earlier, a lot of earnings momentum in the stock.
Okay, the week ahead is going to bring a couple of reports on inflation. I'm sure you'll all be keeping your eyes on that, and we'll talk about it next time we get together here on Profit from the Pros.